Chapter 2, Concept Video 2. This is an introduction to debits and credits. Part 1. We're going to do this in two parts. First part, we're going to look at the account as a basic classifying and storage unit for an accounting information system. An account is a part of the accounting system that we use to classify and summarize increases and decreases and to determine the balance of each asset, liability, and shareholders' equity section, revenue and expense accounts. Firms set up accounts for each different business element, such as cash, accounts receivable, accounts payable, revenue and expenses. Every business has a cash account in its accounting system because the knowledge of how much cash on hand is very useful. To illustrate an account, visualize what we call a T account. That's it, just a T. And we give the account a name, for example, cash. Now you'll notice there's the left side and a right side to this T. So the rule here for this one is we're going to record increases in cash on this side. This is for increases. Any transaction that decreases cash will be recorded on this side. Now, I told you that accounting language comes from the 14th century Venetian time period. Guess what the word for left side is? In their language, debit meant left and credit meant right. That's all. So on the T account, this side is called the debit side, and this side is called the credit side. Debit is Old Italian for left. Credit is Old Italian for right. Now, people who have trouble with accounting confuse the word credit because credit in the English language now has other meanings. You have good credit, you have bad credit, I give you credit, I don't give you credit, and so on. But in accounting, credit simply means right-hand side of the account. If you can keep that in mind, then you'll go a long way in analyzing transactions properly. Now, we've seen that each business transaction is an exchange and therefore affects two different accounts in the accounting equation. And in a business transaction, we record the total dollar amounts of debits, and they must equal the total amount of credits. When we debit one account for, say, $100, we must credit another account. In that way, we will always be on balance. If we have, every transaction has a left-hand side and a right-hand side, or a debit side and a credit side. This is called the double entry accounting system. Now, recording transactions in the T account is easy when you keep in mind that the equal sign is the balancing thing in the assets equal liabilities plus, I'm going to say, plus shareholders' equity. Assets are on the left-hand side, and therefore we're going to say they increase on the left-hand side. Liabilities and shareholders' equity are on the right-hand side, so they're going to increase on the right-hand side of the liability account or the shareholders' equity account. If there's a decrease in the assets, we're going to record that on the right-hand side of the asset account. If there's a decrease in liabilities or shareholders' equity, we're going to record that on the left. And in this way, we can record every business transaction in this shorthand fashion. So again, to summarize, you know the left side of the T account is the debit. The right side is credit. Debit means left, credit means right. That's all. So here we go. Assets. Debits increase assets, credits decrease them. In liabilities, we record decreases on the debit side, increases on the credit side. And the same thing here. Decreases on the debit side, increases on the credit side. And that's all we have to remember in recording every business transaction. Keeping these two rules in balance at all times.